Welcome back to another session of C4S classes where we are discussing objective questions that are relevant for RBI examination. So today we are discussing Global Financial Stability Report which is published by IMF. So we'll be discussing now uh, certain terms that appeared in this report. So as you can see, a paragraph was given from the Global Financial Stability Report and some sentences were taken from that report. And from those sentences, certain terms appeared and that questions were asked based on those terms. What does those terms mean? So let's first discuss these terms in detail. Okay. So as we know, this report is published by Global IMF, okay, Global Financial Stability Report, and the theme for this report is the last mile financial vulnerabilities and risks. The first term that we are going to discuss is soft landing. So soft landing is when central bank is using monetary policy tools to slow down economic growth gradually to prevent overheating or high inflation while avoiding a recession. So what does that mean is central bank takes certain steps that helps to prevent overheating, that means or high inflation in the economy, as well as those steps doesn't hurt that much that recession may come. Okay, so it's a trade-off, it's a balance between stable economic growth with or and controlled inflation and steady growth. Okay, and if you read the preamble of the RBI, there also one of the duties of the RBI is to have is to make sure that the economic growth should be stable with controlled inflation. Okay, now comes the second term, that is term premium. So term premium can be called as a additional yield that is required for holding long-term bonds as opposed to short terms, short term, right? So if you see a graphical representation of a yield curve, so this is yield, this is time period. So as the time period increases, the general uh, the general graph of yield curve should be that it will rise from the base. So this increase can be called as the term premium. And this premium is given so that investor would invest in securities that have a large maturity period instead of a smaller one. So if a bond has a smaller maturity, so for that smaller maturity, yield would be this one. As the bond is getting a large time period, the yield would be this one. So this can be called as the term premium for this yield or for this bond as compared to, right. So in a way, the term premium compensate investors for the uncertainty and the risk associated with changes in interest rates and inflation over long period. Okay. So third term that we're going to discuss is hard currency. So hard currency is the currency which is widely accepted and has stable value. Okay. In international transactions. Right. So this kind of currency is generally issued by economically and politically stable country. Because such currencies would have uh, would be having a reliable store of value, storage of value. Okay, that means volatility will be less. Examples can be US dollar and euro, right? Yen can also be an example. For fourth term is taper tantrum. So taper tantrum is a term that was coined in 2013. So at that time, after global financial crisis in 2008, US was involved in quantitative easing program. So they were purchasing assets. That means interest rates were low. Now in 2013, they reduced or tapered asset purchase. Tapered means reduced. So they reduced the asset purchase. That means interest rate increased. So it led to financial market volatility. And it was this volatility happened because of the tapering of asset purchases or increase of interest rates. That's why it is known as taper tantrum. Now, next one is intertemporal trade-off. So, intertemporal trade-off is a choice between present consumption and future consumption. So, it includes decisions such as savings money for future instead of spending it now, right? So, let's example investing in resources or in projects that will yield long-term long-term benefits. So, long-term benefits and there is short-term benefits. So if a choice has to be made between these two, either you can have long-term benefits or short-term benefits, then this is a classic situation of a intertemporal trade-off. All right. Now that we have discussed these terms, let's quickly move back to the questions that were asked. So in the report, the one sentence was taken is the global economy appears increasingly likely to achieve a soft landing and cracks in the financial system exposed by high interest rates have not ruptured further. So here soft landing meaning was asked. Answer is a situation where central bank successfully slows down economic growth without causing a recession. Okay. Second question was the 10-year treasury yield approached 5% at one point, driven by a term premium increase of around 70 basis points as the sell-off that started in mid-September 2023. So term premium was asked. The answer would be the additional yield that compensates investors for the uncertainty associated with holding long-term bonds. Now, third question, in the hard currency bond market, emerging markets across the rating spectrum will also need to refinance or issue new debt close to current secondary market yields, which are significantly above the coupons paid on the existing debt stock. Hard currency was asked. That means the currency that is widely accepted and has stable value in international transactions. Fourth question was the Federal Reserve is shrinking its treasury holdings by 60 billion per month, but may taper quantitative tightening in the second half of 2020. So the term taper tantrum was asked, which refers to a sudden increase in interest rates and market volatility caused by concerns over the reduction of central bank asset yields. Fifth question was easing financial conditions by stimulating economic activity could result in policymakers facing an intertemporal trade-off in terms of downside risk to growth. So what is an intertemporal trade-off? It is a choice between present consumption and future consumption. So that's all for today's session. Thank you and have a nice day.